So, competition in clearing and settlement. Obviously, LCH hugely in the news at the moment. You know, I'm not quite sure what you want to talk about or what you can disclose, but do you want to talk a little bit about, you know, competition and what that means for LCH?
Yeah, I mean, we've been around, I think, for 124 years, and probably about 122 of those have been pretty much where competition wasn't fierce. And in the last 2 or 3 years, competition has just exploded. In equities, in listed derivatives, all the products. I mean, we clear the entire stack, so from repos to equities, from FX to interest rate swaps, from freight to metals. So we're pretty much competing with not just one clearinghouse, we're competing with multiple clearinghouses that might specialize in one of those areas.
So, looking at, you know, the technology, you say you clear right the way across the grid, and then looking at different asset classes. How does the technology, do you have to have different technology for different asset classes? How are you going to grow, and what technology solutions do you have?
Yeah, I mean, we've had a slight change in strategy. In about 2005, we tried something called the generic clearing solution. Needless to say, it didn't go very well, and since then, we've pretty much focused on solving particularly issues in particular asset classes with particular technology solutions. Not to say that someone further down the road might come up with another generic clearing solution, but pretty much we're really, really focused in terms of just solving problems. We don't think there's a one technology solution that fits all of our business problems.
That's interesting. When we had the panel earlier, people talked about harmonisation, but I think that harmonisation was much more around standardisation, probably around message formats or protocols. You're saying that, you know, the generic, you know, fits-all model doesn't work. Is that in terms of the actual architecture, or in terms of messaging, or which aspect are you talking about?
So I think, yeah, I mean, some of the messaging, will, you know, we're all moving towards standardized things, but again, you know, you have different protocols for different asset classes, so FIX, FIXML, FPML, that kind of thing. But, you know, some of the way we do risk, you know, is different depending on the asset class, depending on the methodology. And so some aspects of clearing, you know, are pretty much standard across the class. But other more nuanced things, I think you just have to take a much more selective approach towards that problem.
And if you were a competitor to LCH, or if you were somebody wanting to set up a competing offering to LCH and you were just starting
I'd just give up.
You'd just give up. Well, obviously, yes. I mean, you know, clearly there isn't anybody else. But well, this is the first panel we're going to have a fight on. I can't wait for this one. I mean, you know, well, there we go. I think, well, maybe on that one. Anne, come on up. It's fight time. Well, I mean, I have to say, yesterday, when we look at the press and the snippets that were picked out about the World Exchange Congress, it was very much around what Equinix and John had said, and it was very much around what Seth had said. So I'm looking forward to the headlines: Nasdaq, OMX, LCH, Clearnet, fight on stage. Yes, here we go.
Yeah,
right.
but I've got the microphone, she hasn't.
No, there are two.
Oh. Here's one I prepared earlier.
Okay. So I have to qualify myself before you ask me questions, all right?
Yes.
Okay, so I'm Anne Neidenbach. I work for Nasdaq OMX, and I'm seeing a lot of familiar faces in the room. I am the American that lives in Sweden, so I'm learning a lot, not only the Swedish language, but I also was primarily front office equities cash person, and now having spent time up in the Nordics, learning much more about the derivatives, the clearinghouse, and those aspects. So there you go. We'll have to see. You'll have to test me.
My question before the fight, and now we can have the fight, I'm looking forward to that. I shall just have to say, next time we do a panel, we'll bring boxing gloves as well, actually. So I'll have to look out for some purple ones. That, yes, you are competing in some instances, and you are collaborating in other instances. What I was going to say is, you know, if you were a new incumbent, what would you have to do? What do you have to do in terms of technology builds to be able to compete against you?
So I get to answer
you can get to answer, and then you can butt in and fight you. Yes.
So interestingly enough, I think this is a question not only our own Nordic markets face, but most of the markets that we sell technology to. We have 70 exchanges around the world that buy trading and clearing technologies for us, And with the whole conversation about regulation in the OTC space, we're seeing that many of our exchanges are asking these same questions. What do I need to do? What is the technology that I need? What do you have? What can I use? How can I, monetize this opportunity, right? Yesterday I was in a surveillance discussion and I said that, it's a bull market for regulation. That's for surveillance, it's for risk management, it's also for risk, OTC clearing, seeing how the trends are if you're an exchange. So I think there's a big opportunity as an exchange, to capitalize on this. There are tools out there. There is the ability to capitalize this on introducing OTC trading. There's partnerships, like we are collaborating with LCH, but we also have a Nordic clearinghouse in which we, last week, or 2 weeks ago, we announced that we do have a multi-asset solution for both exchange-traded and non-exchange traded OTC products. So we are building the 2005 product that you said didn't work out. Now, what I would say is there is commonalities. There's certainly components of clearing that is common, and there's certainly those that are not. And I would agree that the differentiator is centers around risk management. You see that for different asset classes, whether it's swaps or commodities or derivatives, you're going to implement a different risk management model, probably. Everybody has span, but they have a variation of span. So, and we see that as we implement that not only in our own markets, but for other markets that we provide technology for.
So Anne's trying where perhaps you had a hiccup a few years ago. You've heard what she said about, how they're using technology. Is it similar and different? And then in a moment, we'll bring in a third person to join the fight on stage. Phil, will you be ready? Off we go.
Okay, I don't dispute the technology, and I'm not a skeptic. I don't want to be like the chief engineer of the British Post Office in 1876 when he heard about the telephone and said, actually, the Yanks can stick to the telephone. We've got messenger boys. But I think technology, and specifically mentioned it, I think the core, where do you get competitive advantage as a clearinghouse, I think is in other areas. I think it's in risk management, it's in the entire product stack because we've got a huge pool. I mean, just in interest rate swaps alone, we've been doing that product now for 13 years. So pre-Dodd-Frank, pre-EMIR, all of these rules that said you have to do OTC clearing. Guess what? We've been doing it. And we've accumulated almost 300 trillion in notional value. And that's, that's just 5 times the size of the world economy. So there's a huge pool already in LCH's sort of expertise. And that's difficult for some new clearinghouse to come. Now, that doesn't mean that, we're going to rest on our laurels. But what it means is you can do things like portfolio managing, because you've got the scale to do that. You've got the liquidity, you've got the members, you've got the transactions in your systems to be able to provide the capital efficiencies for your clients.
So capital efficiencies, competition. You've got 2 competitors sat next to you. You can fight with them if you want, or we can just debate with words. And
obviously,
but it'll be WEC cage fighting next year. I'm looking forward to that one. Right.
I think XClear hasn't been in the business for as long as LCH. We are a new entrant. We started clearing in 2003, and yes, we are primarily an equity-based clearinghouse. And just to pick up on a couple of points that Anne made around functionality. From a user perspective, we saw that in your region as well, where clearing is recently being introduced and competition in clearing is being rolled out later this year. We noticed that the community there didn't necessarily have all the tools or pens in its pen box to do the business and support its client base, especially from the GCM side. And the general clearing members, or those members that wanted to become general clearing members and clear on behalf of third parties, didn't have the capability that they needed in their back office platforms. And what we did as a new entrant, trying to compete on the technology side, was to build out our platform to manage the NCM level of granularity through the clearing model and produce all the reporting at a very granular level, and have bells and whistles that went off when certain limits were reached in order to try and bridge that gap. So that, combined with a flexible way of communicating out to the client base, puts us in a competitive position in hopefully grabbing some market share off the incumbent CCP.
So we talked there about innovation. we're in a time in the market where you've got huge pressures to meet new regulatory requirements, but at the same time we've got a backdrop of not the greatest economic climate. How do you balance trying to find the right solutions and the right technology at the same time as balancing the books, as it were?
Well, for us, I think, again, we're quite limited on the equity clearing side. We're diversifying our products, and we're looking at the securities lending and borrowing market especially. In the current conditions where collateral is very stressed, the market is very stressed, we're looking at how we can bring a centrally cleared stock loan transaction to the market to facilitate equity financing transactions. And that hopefully will bring some value into the users and pull the buy-side positions into the leverage side and make that an attractive proposition. We're focused on the derivative space. We don't have that capability at the moment, but it's the same question: do you buy, build, or partner? And that's work in progress with us at the moment.
So, Anne.
So again, I think the last time I was talking, it was more from a market technology perspective. I think now, if I speak from our clearinghouse, what we saw is our big announcement last week, 2 weeks ago, with a multi-asset clearing solution. Yes, clearly that's great for an exchange, but the big benefit is to the local broker. We can introduce cross-margining, right? So you can, instead of having capital that you have to put up for commodities, derivatives, fixed income, repos, right now we have introduced in the Nordics a cross-margining opportunity that you could share that collateral across asset classes. And again, that's been very, very powerful as we roll that out. We're looking to extend that into other asset classes. We've also built a common default fund. So again, I think as there's constraints more and more on banks, they're trying to reduce the capital that they have to put up. They're trying to manage their expenses. I think that those two combinations, a multi-asset platform, the ability to provide the cross-margining is a very powerful story.
So almost providing more is allowing you to be able to have a function for the banks to be able to, for them to be able to do more with their money as well in terms of capital requirements. Is that the same for yourself, Saj?
Yeah, I mean, we announced with conjunction with the New York Stock Exchange and DTCC a sort of a single pot margining for futures, cash equities, and interest rate swaps, and that, we think that's going to give clients, significant benefits in sort of in the billions. But, in sort of my role as IT strategy, I feel always have that one foot on the brake, one foot on the accelerator. So the accelerator is always more products, more capabilities, more geographies. And the brake is, less cost, less headcount, less infrastructure in the data center. And we're having to, as most of you guys are, you're having to deal with that dilemma all the time in terms of the kind of the innovation that you have to bring, but you have to bring it with one eye on the P&L. And, we're doing a lot more with partners. We're looking at more around some of our offshoring. So, you're going to have operating models where your head office is in London, your IT people maybe in India, and your data centers are going to be, in different places because, one of the other things that's coming out of the Dodd-Frank and EMIR is, critical market infrastructure players are going to have geographical distant business continuity locations. So it's not enough now, for example, to have something on, an office in London and a data center in London, or a backup in London as well. Because if London gets knocked out, how do you actually serve the market? So you're going to have to start looking, at your international footprint and your operating model in a lot more detail because to adhere to the new regulation.
I mean, in the last couple of years, we've had some sort of quite large sort of fallouts from the market. And given the fallouts in the market, what technological changes have you made, or haven't you had to make any technological changes because you were already set up to deal with the fallouts of some of the big names that we've seen?
Well, from an ex-Clear perspective, some of you were probably here when Urs was on stage earlier. We benefit from the fact that we do run a real-time risk management platform. And during that period in 2008, when Lehman's fell out of the market, it was at the same time Sibos conference was on. And there were a number of CCPs at Sibos, and our CEO at the time, I think, was one of the few that didn't get on an aeroplane to fly back to Zurich to look and manage the risk positions. We were fortunate that we had those positions, we had the clarity at the touch of a button. So we feel that the risk management aspect, it works very well. It is as real time as we can get it. Some of the other aspects when we sort of talk about the value of real-time and real-time reporting and the challenges that some of the users face on the collateral side, if you impart real-time information, the users have got to be able to use it. And we often find that we're over-collateralized because collateral pools aren't being managed as efficiently as possible. So we sort of talked a little bit earlier about the ability to have a broader range of products which you can benefit from a more efficient collateral process. Absolutely, fully agree with that. Even with a narrower set of products, we find that the collateral isn't necessarily managed effectively. Competition's been focusing on headline clearing costs, which are now very, very narrow, and I think we're all pretty much on the same level. There's no more fat in the game, I don't think, to really take out of that. And the next focus should really be on the effective management of collateral.
So Anne, is that the same for you? Do you need to make any changes? Do we have to make changes to margin management, or are you in a good position?
Yeah, no, I absolutely see that the trend is moving everything to real time, right? It is all about risk management. It is all about margin, simulation and calculation. And the more that you can do that with tools on your platform intraday, so you understand how much margin you have to have available, or what risk you have, and you can monitor those positions, I think that's important. Now, clearly it's important for the clearinghouse, but it's extremely important for the broker and for the clearing member as well. So I think what you're going to start to see is, as a lot of the OTC market moves onto exchange with regulation, I do think there will be an extension, a lot of the risk management tools out to the brokers, because they need to be able to manage that as well in real time, and not through overnight reports and big database runs.
And the same for you, Saj? Do we need to do more customer fund segregation, margin management?
Yeah, well, that's the big thing that came out of Lehman's, because we had to deal with a 9 trillion Lehman's default and 66,000 trades, all, with no one there really to tell you what was going on. And we managed that within 3 weeks. So it just shows you the value of a sort of a clearinghouse, because, bilaterally, people are still trying to get their money back from Lehman. So as a clearinghouse, we fulfilled our role within 3 weeks and returned money back to the administrators. But what came out of Lehman's was a key drive towards segregation, portability as well, which is key. Mm-hmm. So if you want to keep your positions, but you want to just effectively port them to another clearing member. So we have to look at, in terms of our technology and our operational, how you can actually create an account structure that can design for thousands more clients, simply because clients don't trust their general clearing member. And that obviously came out a lot more in the MF Global, where, a lot of people, have lost money, from sort of big banks to ranchers and small businesses. So that whole thing around account structures, segregation, portability, that's a big issue for us.
So, members of the audience, we've heard for the last 20 minutes from the guys on the panel. Are there any questions that anybody's... Oh, hands straight up. Right, 3 hands. What an excellent panel. This is brilliant. Oh, I know. Well...
It's Riva BT Radiance. What is
and definitely
planted.
Not planted. Not planted.
What is the impact for you from T2S?
Target 2 securities.
Yeah.
Sure.
Yeah.
Do it after you.
We have obviously our Paris business is effectively in the Eurozone, and it has to have a banking license, so it impacts much more our Paris business. And as part of the industry, we're obviously going to significantly be impacted it. But like Alex said, that is just one part of a significant, I call it a tsunami of regulation that's hitting us in, and we just haven't really factored in. I mean, everyone's sort of saying, the regulators are doing this and the regulators do that. In one sense, the regulators have to do something. What happened over the last 3 years, the whole world was on the brink of a depression, so someone had to do something. The question is, and we can't just blame them and say, look, what they're writing wouldn't have addressed what the problems were, because then we'd accuse them of just being in the rearview mirror, of just fighting the last war. So we're going to have to deal with it. We're going to have to see what the opportunities are. There are a lot of opportunities for clearinghouses. There's a lot, potentially a lot more revenue heading our way, but we've got to also do it in the interest of making markets safer and benefiting our clients. So target 2 is just literally, it is a significant issue for us, but it's one of multiple significant issues for us.
And given it's what 2014, 2015, you've got a little bit of time.
And going back normally.
Yeah.
Oh, going back, right.
Yeah,
Well, okay,
I
Anne.
would say right now, we are looking, we are dealing with each regulation directive sort of in time that they come, right? So EMIR and then MiFID II and T2S is definitely something that we're discussing clearly with our own CSDs that we have within our Baltics and our Nordic countries. That is, something that we have our eye on and we need to have a solution for, and we need to develop to meet those requirements. I think what's interesting for us is then when we look to take that CSD technology and sell it to other regions, what is that regulation? Should we talk to our regulator? Do we have to do it? So it is kind of interesting about who's driving regulation. Is it the European regulators? Is it the US? Where does this factor into the Middle East? Where does it factor into Asia?
Phil, T2S for you, and then maybe we could come back around and talk about EMIR and EMIR solutions.
I think we're in the same boat with T2S, to be honest with you, but what we do see is a real opportunity to expand our clearing model. I think we're very conscious that there isn't a one-size-fits-all model. There are different products, there are different flows. Certainly the product suite will increase. The structured business is likely to flow through with equity financing trades, securities lending and borrowing market. I don't think that's really had the due focus yet. It's around the corner and it's coming, and it will lead to us to diversify and build out our product suite and our capability from a technology standpoint.
So EMIR, it's January. It's not that far away.
I mean, we just finished sort of a massive consultation. So ESMA have been issuing consultation, and we just did a significant. And I've just noticed on the website there's 100 responses on the ESMA consultation alone. So there is significant water coming under the bridge here, and we've got 3 bridges over the Bosphorus. There's enough water there. So I think potentially EMIR is going to go on one path. But what we're concerned about is regulatory arbitrage, because just one example, record keeping. I mean, EMIR says 10 years for everything. From your, I don't know, in your offices, you tape all your conversations electronic. So that's 10 years, from all your client data, 10 years. It doesn't mean for a 50-year swap, we clear a 50-year swap. Does that mean we have to keep it for 60 years? So whereas, Dodd-Frank is potentially 5 years. So what do? Do you deal with the worst case? So do you deal with everything with 10 years because you're multi-jurisdictional? And that's just one example of a number of things where you're going to have to judge, which regulation you deal with. Because, the only thing this is really, really benefiting is a bunch of consultants in the regulation, because they can charge whatever they want to charge at the moment. They're the only ones reading really every single paragraph and colon.
But for the consultants in the room, we like them, don't we, normally?
Absolutely.
Yes, exactly.
And I use many of you.
So the only thing I would add to that, and again, I don't have our general counsel here, but as I understand it, we're looking at EMIR as a directive with a local implementation. So it really is about that local implementation and working with your regulator and figuring out how that nuance is. And there is the general constructs of some of the big parts, like retention and whatnot. But again, I think the overall focus is more about the transparency of OTC trading and making sure that is more transparent and that is not, hidden through voice broking. So.
And EMIR for you, Phil?
Yeah, I agree with both. I don't really have anything else to add to EMIR, but I think we're maybe one step ahead on the data warehousing now. Our lovely regulator already forces us to keep data for 10 years, so we're a step ahead in that one for once.
Oh, so you're ahead of the game. Right, the other hand I saw up was Jan, wasn't it?
I have a provocative question for you.
A provocative question.
Yes,
well,
we've
had fighting and now we've got provocation.
First
Excellent.
statement. The regulators are going to mandate a central clearing for OTC markets, and you're all sitting in front of us right now, and that's 3 of you. So 3 of you doesn't really make central clearing, it makes fragmentation in the clearing arena. You just went through interoperability clearing on the equity space, which took much longer because of the regulatory authorization that came much after the technical people were ready. From an OTC standpoint, don't you believe that central clearing with 10 different clearing houses is not going to go into another fragmentation mess, and that will be able to achieve what the regulators want? That's the first question. The second one is, what did you learn from your experience in equity interoperability clearing that you may want to apply to the OTC clearing?
Right, hands up, who wants to grab that one first? Oh, a nice meaty question. Hey, well done, Anne.
All right. So, my friend, I guess my observation, and maybe this is a good viewpoint for me because I come from an equities background. I think what I see that is very interesting is, one, you're going to see the exchange clearing start regionally. I think that's what we're going to see. And I think from my vantage point, whether it's selling technologies to exchanges in Europe or in Asia, and then watching our own clearinghouse, I think it's about making sure that you provide that service for OTC trading in that region. I think then you get to a point of where is the interoperability needed. And I think you're going to see, again, the same trends. I think this time it'll probably start in London. It'll start there as opposed to in the US because we have the utility of DTCC. But I think personally where one of the opportunities is that I'm seeing is as smart order routing evolved in equity, I think we're going to see a similar type of a concept in this space, in that middle office, in the clearing space, which may make it very interesting.
Interesting take. Phil?
I think I'll take the second question. Interoperability for the cash equity markets has really only just started. It's really come on board in the last few months. We've achieved, I guess, coverage around about half the mature European marketplaces today. People are just starting to vote with their feet, in fairness. A lot of institutions still have some technology changes in order to move their flow, migrate their flow to their preferred CCP. That work generally isn't done up front until it became real. So now we do have real interoperability. The flow is starting to move. And there will be winners and there will be losers. And I don't expect there'll be the same number of CCPs in this space in 12 to 24 months time from now. The challenge that we have left, that I think was addressed on a previous panel, is getting the rest of the regulated markets to open up to interoperability and to break down those silos and to provide choice across the rest of the landscape. We've worked very hard to build our technology links out to many MTFs and as many regulated exchanges as we possibly can in order to provide the broad footprint which will lead to that collateral consolidation and concentration of clearing through one preferred CCP. There's room for more than one, but the current number I very much doubt.
Saj?
I think on cash equities, I mean, it was a long and painful exercise. And to be honest, if you can't do that in cash equities, it makes me wonder what's going to happen in the other asset classes. I mean, even in cash equities, and ourselves and XClear have been interoperable for the London Stock Exchange for a few years, but it's only the MTFs recently, and guess what? Frankfurt still isn't interoperable, NYSE still isn't interoperable. So effectively, you even haven't got a significant portion of the cash equities market interoperable. If you look at the OTC products, if you look at CDSs, ICE have probably got a significant open interest pool now. I've referred to our sort of dominant market share in interest rate swaps. FX is now, we've launched a service, CME are in there, ICE are going to be in there. We'll see what traction that gets. But, there is going to be room for multiple clearing houses, but you're going to have to see, what benefits you can bring to the market, whether you've got enough scale, whether, at the end of the day, it makes commercial sense to keep clearing in areas where actually the volumes aren't huge, you're not really offering any portfolio benefits.
Jan, did they answer your question?
Well, sort of, except that when you have two clearing houses clearing the same product, then either you have interoperability, or for the venues that execute the trades, you need two different order book. And if you have two different order book, then you're fragmenting your own market when it's not really necessary to fragment the market.
Yeah, the question, I think, the problem is, the logical argument to that is that you have one clearinghouse either, or one clearinghouse per asset class. Now, the question therefore for regulators is is that then effectively does a clearinghouse become too big to fail? I mean, imagine, you know, in a $300 trillion interest rate swaps market, LCH effectively clears that. I mean, we are effectively 95% of the cleared market in swaps. So pretty much your fragmentation argument actually doesn't apply in certain areas.
Oh, there's a quick snatch of the...
But I do think
I
that...
thought that might provoke her.
I think there's now, and I think there's going forward. I do think that there is a big opportunity, and again, you know, I see this very similar to, you know, early 90s trading equities, right? You know, it was all voice broker, right? And then, you know, all of a sudden you could see, I think it was, you know, sets or the one before it, you could see the electronic display. We had the same thing at Nasdaq, right? Then you could pick off those quotes, right? Then you started to have multiple venues, and then you had to route. And then I do see that there is a similar trend. It may happen it may happen more rapidly than the 10 to 12 years it took to get the full cycle for equities, but I think people get it. People are still working in that lifetime, and I think that will evolve. So I think, you know, routing, I think data, I think the ability to see to see things electronically, I think is going to proliferate, you know, make this come along much quicker.
I mean, to be fair on interoperability around equity, I mean, there were 50,000 different consultation committees to be able to get to where we are now. It's a bit like consolidated tape. There's 17 different working groups on that, and I think, you know, maybe the same will be in terms
for
of
one asset class. The OTC market, like Sajjad, you were saying, it's more than one asset class. So if you say that fragmentation is by asset class, I kind of agree with you. If you say that it's within the same asset class where the interest rate swap could be cleared through 10 different clearing houses, that's going to create potentially a massive issue because the liquidity is not the same.
But in our near future, that's going to happen. I mean, that we're not going to move to one clearinghouse, right?
Thank you.
Yeah.
Well, there we go. I think we might have got one quote then for the day then, rather than the fight quote. Yes, exactly. Any questions from the art gentleman at the back? Lovely to hear. Thank you to hear. I really appreciate the questions.
Tahir Taslaman, Sarajevo Stock Exchange. I have a question for all of the panelists. How do you comment on horizontal integration versus vertical integration in terms of profitability and competition itself? Thank you.
Phil, do you want to kick off with that?
Sure. I mean, we're very much of the opinion that we should have choice in the market, and a horizontal structure is the way to go. It provides the opportunity for institutions to consolidate. Profitability, sure, there are going to be some winners and losers in the market, definitely. I think if you look at the recent history, in the way that interoperability has evolved with LCH and XClear, the fees have come down by a tremendous amount. As clearinghouses, we've started to become more innovative, and I think that's good for the marketplace. I think the regulation is going to drive innovation forward as well, as we start to have more products forced into a cleared model because capital requirements are so costly. And I think there should be choice. I don't think there should be a monopoly approach to clearing. And I think the recent proposed acquisition by the LSE and LCH Clearnet has already been stated in the press that they want to remain as a horizontal model and have the freedom of choice there.
Can I speak again?
You can speak again.
So
as you heard, the question was for all three of you.
All right. Obviously, the horizontal model is the best. I mean, you look at it from the banking industry, that's exactly what they want, right? You know, 10 years ago, I was working in London, and we were talking about that, you know, and that was what evolved the EuroCCP, to be honest with you, and going around each of the banks and talking to them about how can we do this, how can we facilitate the fungibility and the cross-border trading and not have it be a fortune. So I agree. I think that the challenge is that there are these verticals, right? There are these legacy venues for derivatives clearing, for swaps, and I think that's going to be hard to break, right? EuroCCP, I believe, started in 2002, and it's really hitting its stride now. So I think it's going to be a long march. Again, hoping that because we've seen it already in our work generation, it may evolve more quickly, but I do believe that that is the right aspiration.
Sajj?
I think, you know, our position on horizontal clearing was sort of well known. I think, you know, in my 5 years with LCH, it's oscillated in terms of market view, you know, the horizontal. You know, I've sat in conferences where I've been told the horizontal model is dead, embrace the vertical, embrace the new paradigm, you know, you can't just be the only horizontal in town. Whereas I think fundamentally it's driven by the users, it's driven by the clients. What do the clients want? If the clients want a purely vertical model where, you know, an exchange does all the clearing and there's no choice of clearing, then that's what they're going to pay for. But I don't think that's what they do. And, you know, our soon-to-be 51% owner also is said on record that they believe in the horizontal model. So we'll continue to clear for as many exchanges, whether they compete with the LSE or they don't compete with the LSE. That is our commitment. And the product governance that we will have in place, the separate LCH board, the 40% minimum shareholding that we'll have from our clients will ensure that LCH remains a horizontal player.
I think we've got time for one more from the audience. Or otherwise we'll wrap it up. Right, we've got...
Mr. Pink.
Oh, sorry, was that a hand up?
Another planted question.
It's because I work for her. Mine is more coming back to the technology part of it. I know we've heard nothing but total cost of ownership, savings. And I was curious about your comment about where you put things in the cloud, or whether, I hate the word cloud as well, by the way, whether you put them in the cloud or you put them in other data centers. But at what point do you actually stop the outsourcing because you're losing control against risk?
Well, it's interesting that the cloud, the debate I have with the cloud is, I think, what the Trojans had around the horse they got from the Greeks. Some of them wanted to burn it, some of them said it's a gift from God. Now, is the cloud a gift from the CIO heaven, or is it potentially a pitfall? Now, you know, I think cloud is glorified outsourcing. Whatever you want to call it, it's glorified outsourcing. The question for you is you've got to look at your own individual situation, and sometimes certain things are more important to you than others. So for us, risk is very, very important. You know, our systems have to be up and running. And if they're not up and running, we can't clear the market. So for us, we have a different risk threshold than maybe someone else. But even in what I call non-core activities of the clearinghouse, why wouldn't we want to embrace lower cost solutions? Why do we need to have our data, those infrastructure in our data centers? So for us, I think the cloud does offer opportunities in certain areas. But you're right, you know, you've got to balance risk, cost, service. Do you want to get into bed with a cloud partner that you potentially have to then stay for a while? And it's all of those different issues. So, and you've got to manage your different key business processes. So, for example, we've got a 2 trillion collateral crunch coming up at the moment. 2 trillion is what the IMF thinks basically the whole industry has to put up for centralized clearing. And 2 trillion is a big number. That you could buy the United Kingdom for $2 trillion at the moment.
If you wanted it.
If you wanted it.
Unified or not unified, yes.
Even, and that's Scotland and Ireland and Wales as well. You get that as well for free. So the question, 2 trillion, where's that 2 trillion going to come from? And, you know, how do we in technology help support the operational, the technology, the processes that underpin, you know, the influx of collateral that comes into your enterprise to be able to do that kind of business? And so you're going to have to, I think, in real-time risk, you're going to have to look at different ways of actually addressing these capabilities other than just putting more and more servers in your own data center.
Yeah, I would agree. There's certain components where we can definitely leverage cloud technologies. And I think, you know, the match, the risk management piece, real-time risk, I think those are going to be outside of the cloud. But clearly the data warehousing, you know, everything from reference data to transaction reporting to data collection and the reports that go out, that is a big opportunity. I think what you're going to see is, as, you know, the cost pressures continue from the brokers, exchanges, clearinghouses, this is an opportunity for them to provide those services. I think, though, the cloud community, and God forbid I offend anybody in here, I think has a level of maturity as well. I think we got to kind of move and really dive into what is a public cloud and what is a private cloud. And this is, this is very sensitive data, and we need to make sure that it's available, reliable, and secure. And I think that secure part is actually going to be a key part of whether or not we can leverage cloud or not.
Phil?
I can't even get my cloud back up to work at home at the moment, so I'm probably not qualified to make a comment on whether we should use it for risk management purposes. I think Urs has made it very clear that we need to look at wherever we can leverage scale, and if that would be a cloud solution, then we need to look at it. But data is sensitive. Regulations force you to house data in certain ways and in certain locations, so there would all be considerations. But for sure, we need to try and deliver an efficient, low-cost, scalable solution to the market.
So my question that I've asked everybody on the panel is, you've got a wand for the year. What are you going to solve, and how are you going to solve it?
I've got a what?
A wand.
A wand. Oh, a ding.
Yes. Like Harry Potter. Yes, other than world peace and hunger. Yes.
Mine's going to be miscongenial.
I would say 2 words: regulation, consistency of regulation, basically.
That's what you'd solve with your.
Sorry.
No, go ahead.
I'd like the other pan-European marketplaces or the European marketplaces to open up fully to interoperability, to give the market a chance to consolidate, and let's see who walks out in 12 to 24 months' time.
Yeah, it might be a little ambitious for this year, but we definitely want to help streamline the middle office processing for the banks. And again, if it's providing reporting services on the cloud, providing reference data, I think that's definitely an area. I think the other thing is educating our exchanges on the sophistication of real-time risk management. I think that's another key place.
Well, you heard their wishes. If you could put your hands together and thank Phil, thank Anne, and thank Sajjad. Thank you very much.